My name is Rayanne Boccianico. I'm an accountant and tax preparer in Clearwater, Florida, and I'm here to discuss today basic business finance principles.
My name is Chris Wilson, and I'm here to learn something about basic business finance principles.
Chris, let's start with the accounting equation. The accounting equation is a simple concept that your assets will always equal your liabilities plus your equity. This is also known as the balance sheet. Okay? So we have assets. And what is an asset? An asset is something that your company owns. So if it belongs to the company, it's an asset. Whether or not you own it outright, you may have a loan against that asset, but it's still an asset of the company. So what are those? You have your cash and bank accounts. Investments, accounts receivable is an asset. It's not cash, but it's going to be cash sometime soon. Inventory, your merchandise inventory, or even your work in process inventory. Office supplies, your fixed assets such as buildings, equipment, patents and goodwill, which is also an asset. Now those are not fixed assets, those are called other assets. Other assets are going to be the intangibles, like the patents, the goodwill, the covenants to not compete, and maybe purchasing client lists from other businesses. A liability is exactly as it sounds. A liability is something that the company owes to somebody else. That's going to be your accounts payable. Your vendor sends you a bill, you owe that money to the vendor, that's a liability. Expenses payable, such as your rent payable and your salaries payable. Also, income taxes can be payable. Sales taxes, payroll taxes, those are all liabilities because you are holding them to pay to somebody else. You may also have long-term liabilities, such as loans or notes payable, credit lines. Those are liabilities, but they are recorded as long-term. So you have current liabilities, which are short-term liabilities. A short-term liability is something that is going to be paid in less than a year. A long-term liability is something that's going to be paid over a longer period of time, like a car loan or a mortgage might be paid over 30 years. Then we also have equity accounts. Equity accounts are named based on the type of company. So you may be a corporation, and corporations have dividends, and corporations have shares of stock, and corporations have retained earnings. But if you're a partnership, you don't have dividends and you don't have stock. You have partners' equity. If you're a sole proprietor, you don't have any partners, so you are an owner, owner's equity, and owner's draw accounts. So the equity accounts names are determined by the type of entity that you're talking about.
Well, Rayanne, now that you've explained the different types of accounts, how does that tie into the accounting equation?
That's a really great question. So we have our asset accounts, and if we add up all of our assets, we come up to one total amount. Then we add up our liabilities, and these are all of the monies that we owe to other people. The difference between assets and liabilities is our equity, or otherwise known as net worth. So if our liabilities exceed our assets, we have a negative equity or a negative net worth. And if our liabilities are less than our assets, then we have a positive net worth or a positive equity account. There is no way that our balance sheet can never balance because our assets will always equal our liabilities plus our total equity.